Lesson 12: How to Gauge the Stock Market's Health. To be a successful investor, understanding the market's direction is critical. In this lesson, Bill O'Neill will show you how to interpret the market's behavior. From your experience, what would you say are the essential steps to successful investing?
If you are an individual investor, whether new or experienced, and you want to make money and perform well investing in common stocks, there are just 3 key steps you must learn and follow. First, you have to develop buying selection rules that let you pick the best stocks and use charts to determine the right time to buy. Second, you must have a set of selling rules that tell you when to sell and nail down a profit or cut short a loss to avoid a possible larger loss. And third, you need a specific method to tell you when the general market averages are topping and headed down, and when they've finally hit bottom and turned into a new uptrend. That's all you need.
What is the general market, and why is it important for you to understand it? Why can't you just buy a good stock and forget about it?
The general market is represented by leading market indices like the S&P 500, Dow Jones Industrials, and the Nasdaq Composite. The reason you need to carefully evaluate these indices is that when they top, then turn down and go into a significant decline, 3 out of 4 stocks, whether you think they're good or bad, will follow the market's trend and also decline in price. Many growth stocks, secondary, lower quality companies in an industry, and even certain high-tech stocks can drop 2 to 3 times as much as the market averages. And worse still, some of them might not come back up or could take years to do so. So, if a bear market declines 20 to 25%, a somewhat normal bear market correction from its absolute top, some of your stocks could drop 40 to 75% from their peak price. It's of no value to make a worthwhile gain during several years of a bull or up cycle and then give it all back during the following bear or down cycle. It's better to get out of the elevator on one of the floors on the way up than to ride it all the way back down. It usually takes investors at least 3 or 4 years to learn this lesson the hard way. So you have to learn to both buy stocks at the right time and to sell them at the right time.
Why do some bear markets last only a few months while others drag on for years?
Since I've been investing, I've lived through 12 bear markets and have carefully analyzed 18 of them going back to the turn of the century. Basic conditions in the U.S. and the world usually determine the length and depth of a bear market. When the U.S. is in real trouble, you tend to get corrections of 30 to 50% in the Dow Industrials. That happened in 1937, a Depression year, 1940 to 1942, start of World War II, 1966, 1969 to 1970, 1973 to 1974, and 1977, years of Vietnam, gold flowing out of the country, OPEC oil price increases, Soviet Union expansionism, rampant inflation, and 20% interest rates during the Carter era. When basic conditions in America are not as bad, like in 1948 to 1949, 1953, 1957, 1960, 1962, 1990, and 1998, you get smaller market declines of around 17 to 27% off the peak. Strangely, many of these declines end in the 4th quarter of the year. Bear markets are normal and necessary and serve to clean up prior excesses. They also allow the market to create a whole new set of chart bases and leaders for the bull market that in time always follows. So never let yourself get discouraged or lose your confidence. Otherwise, you'll miss the next bull market.
The experts never seem to agree about the market. How do you tell who's right?
I don't listen to any personal opinions about the market, but instead study the day-to-day price and volume changes in the leading indices. I'm not trying to predict the market into the distant future, but merely to understand its exact condition at the time day by day. Is it in a confirmed up or down trend, and is it acting in a normal or abnormal manner? We put all the important market indices on one convenient page in Investor's Business Daily, the General Market and Sectors page, which I check every single day. The 3 key indices are stacked one on top of another to help you spot divergences in action at key turning points. For example, one index may drop to new lows, while another, broader index, such as NASDAQ, may diverge and hold above its prior low, indicating strength in a wider part of the market and weakness in another. Investors Business Daily has also placed its mutual fund index on this page because it has, at times, been an excellent general market indicator. Investors Business Daily also has a one-of-a-kind column called the Big Picture. It will help you learn how to decipher the many changes that happen in the various indicators on the general market and sectors page. I have personally found the dozens of other technical market tools followed by most technicians to be far less reliable than just watching the behavior of the key market averages daily and the action of individual stock leaders.
If you liked the video, please click the like button below and subscribe to the channel. Summary. The general market is represented by leading market indices like the S&P 500, Dow Jones Industrials, and the NASDAQ Composite. Tracking the general market is key because most stocks follow the trend of the general market. Ignore personal opinions about the market. Instead, study the day-to-day price and volume changes in the leading indices. Investors Business Daily's General Market and Sectors page will help you understand what is going on now in the general market. The Big Picture column will help unravel its complexity. A typical bear market will decline 20 to 25% from its peak price. A negative political or economic environment could cause a more severe decline.